Okay, so let's finish this up. After you've prepared your financial statements, what you want to do is you want to prepare closing entries. Now, why are you having to prepare closing entries? The reason why is because you have accounts that are um, temporary and you want to close those temporary accounts. And what you're going to have left over after this closing process of closing temporary accounts is you're going to be left with permanent accounts. Well, what are temporary accounts and what are permanent accounts? Temporary accounts are those accounts that have you use during the accounting period, but have to be reset to zero at the end of those accounting periods. Those are revenue accounts, expense accounts, the dividends accounts, and also something called the income summary accounts. Um, the income summary account is a very temporary account. It's used only in the closing process, as you will see. And so you're going to identify the accounts for closing: revenue, expense, dividend, income summary. You're going to record and post the closing entries. And then after you've done all that, you've closed all your temporary accounts. What you're going to be left with is nothing but permanent accounts. And what you want to do is you want to run a post-closing trial balance of those permanent accounts to make sure that your debit balances in those accounts equal credit balances. Because if they don't, you have a problem. So again, permanent temporary accounts are revenues, expense, dividends, and income summary. Permanent accounts is everything else, so assets, liabilities, and all your uh, equity accounts, retained earnings, and common stock. All right, so this uh, process of doing the closing entries requires 4 steps. First thing you're going to do is you're going to close out the credit balances in your revenue accounts to income summary. You're going to, number 2, you're going to close out your debit balances of expense accounts into income summary. And what you're going to end up with after those 2 entries is the difference of those amounts is either, well, it's usually going to be a credit balance, which is the sum of the difference between your revenues and expenses, and it's the same amount as you reported for net income. And so you're going to take that difference and you're going to close that out into retained earnings, thus closing your income summary account. Now, for step 4, you still have your dividends account open. Remember, dividends account is a special type of expense account. And so you're going to credit the dividends account and debit retained earnings, reducing retained earnings. So let's look at this. So we got our running example that we've been using. And so step 1, they've got a balance in revenue accounts of $78.50. So they debit consulting revenue for 7850 and rental revenue for 300. So the total of those is 8150. So they debit 7850 and 300. Their credit's going to be the income summary of 8150, the sum of those two amounts. So that's step one. Step two, they're going to close their expense accounts by debiting all those accounts, and that sum is going to be your so they're going to be crediting to close out those accounts, right? And the corresponding debits is going to be the sum total of all the expense accounts. And so that's the amount that you debit in income summary. And notice that the difference here is $37.85, which is exactly the same amount as net income. Okay. And so what you have at the end of the period is a debit balance, a credit balance of $37.85. And so you want to debit, to close out income summary, you want to debit income summary for $37.85, and your credit goes to retained earnings. Okay, so that's step three. And then step four, you simply, you have a debit balance in dividends accounts, so you want to credit dividends, and your debit goes into retained earnings. And after you've done this, you've got your post-closing trial balance that you need to run, which is going to list all of your permanent accounts. And you're doing this again to make sure your debit balances equal your credit balances. And in this case, they do, so you're good to go. Couple of things we need to talk about: the accounting cycle. Sometimes well, and we've talked about this, but you know, some people call it the steps in accounting. Some call it the accounting cycle. You know, whatever you want to call it. But it's a 9-step process and possibly a 10-step process, because the 10th step is optional. And so we've gone through this, but we haven't pointed out necessarily that that's what we were doing. We were going through this accounting process or cycle. So recall that step one, it starts with analyzing transactions, usually through source documents. Next, we journalize the accounts that are affected, and then we post to the ledger accounts that are affected. At the end of an accounting period, we prepare an unadjusted trial balance just to make sure our debit balances and credit balance equal. Remember, that doesn't necessarily mean that we put everything in the right account or at the right amount, or at the right amount. At the end of an accounting period, we make our adjusting entries. And after we make our adjusting entries, we prepare an adjusted trial balance. From the adjusted trial balance, we can prepare 4 financial statements. We didn't talk about the statement of cash flows, but hopefully we'll have time at the end of this term to do that. Next, we do our closing entries to close out our temporary accounts. And after we close our temporary accounts, we're left with nothing but permanent accounts. And then we run step 9, our post-closing trial balance, so that we can determine that our debit balances equal our credit balances in our permanent accounts. last but not least, you might have to do some reversing entries, but again, that's only if you need to. All right. Um, Up till now, when we saw our balance sheet, it was, you didn't know it, but it was a an unclassified balance sheet. In order to make a more orderly balance sheet, we normally try to classify things. Um, and so what we do, and there's no right or wrong way to do this. Um, if you prepare an unclassified balance sheet, it doesn't mean you've run afoul of GAAP. It just means it's an unclassified balance sheet. But again, remember who your users are. They're third parties, external users who are um, not may not be familiar with the company at all, and certainly they don't have um, inside information necessarily on the company because usually they're not involved in the day-to-day operation. So the bottom line is to try to make um, the financial statements easy to understand. And one of the ways to do this is to classify your assets, liabilities, and equity accounts into a classified balance sheet. And so we do that by listing things as current versus non-current as far as our assets and liabilities are concerned. Current items are those that are expected to become due, uh, both collected and owed within the longer of 1 year or the company's normal operating cycle. And the operating cycle of a company is defined by the time of amount it takes to essentially buy inventory, produce whatever it is the company produces, and sell it and collect the money back from the customer that they sell the product to that they've made. Um, Normally, companies have an operating cycle of less than 1 year, and most companies have numerous operating cycles throughout the year. But let's take Boeing, for example, a semi-local company up in Seattle. Uh, when they get uh, when they build a jet, they have to buy inventory, raw materials inventory, as you'll discover, to make that jet. And so they have to make an outlay of cash for the inventory. And, they bring together all the raw materials and produce a jet. And that definitely takes more than 1 year to do it. And so for someone like that or some company like that, their operating cycle of buying inventory, producing the product, selling it, and receiving cash from the customer is going to be uh, over 1 year and maybe 18 months, maybe 2 years. But most companies have an operating cycle of less than 1 year, so you could actually read that as um, current items are those expected to come due, both collected and owed within 1 year. So current assets would be those assets that you're going to utilize within the next year, and current liabilities are those that you're going to obligations that you're going to pay or satisfy within the next year. So current assets are expected to be sold, collected, or used within 1 year, depending on the type of current asset it is, or the company's operating cycle if it's longer. Long-term investments are expected to be held for more than 1 year or the operating cycle. Planned assets would be listed under property, plant, and equipment, or long-lived or long-term assets. And these are used to produce or sell products and services. Property, plant, and equipment, land. Intangible assets are long-term resources used to produce or sell products and services and that lack physical form. An example of those would be like patents, trademarks, copyrights. Current liabilities are obligations due within the longer of 1 year or the company's operating cycle. Long-term liabilities are those that are due, going to be satisfied in more than 1 year, longer than 1 year. And then equity is the rest of it, whatever's the difference. So this is what a classified balance sheet would look like. You break it up between current assets and long-term assets or plant assets or property, plant, and equipment, however you want to list it. And then you would total up the sums of current assets plus plant assets. Same for liabilities. You divide between current liabilities and long-term liabilities, and then you have your equity amount. And then the sum of total liabilities plus equity is going to be total liabilities and equity. All right, so that's it for chapter 3.